They taught the Cold War as a contest of missiles, ideologies, and proxy armies. But look deeper, and a different fight comes into view. A war of ledgers and lines of credit, a hidden economy that decided who could finance wars, build alliances, and remake markets. This is a story not of battlefields, but balance sheets, of ministries, bankers, intelligence operatives, and oil ministers, of secret loans and offshore accounts, of how financial plumbing, banking relationships, reserve currencies, and covert funding shaped the global map. This is the trail of money that we must follow if we really want to understand the modern world. After World War II, Western powers assembled at Bretton Woods to avoid the monetary mayhem of the First World War's aftermath.
The architecture they constructed gave an unprecedented central role to the United States: a dollar convertible into gold for central banks, institutions to manage development and stability, and a system that made the dollar central to international trade and reserves. This structure did more than stabilize currencies. It gave Washington an invisible lever over global credit and commerce. Countries that held dollars effectively held access to global liquidity, and the U.S. could shape patterns of trade, aid, and finance through that central position. The implications were huge. Money became inextricably linked with geopolitical influence as much as with an economic tool.
FederalReserveHistory.org. At the same time, Western Europe lay in ruins, and political leaders feared the economic vacuum would be filled by the Soviet Union's model. The Marshall Plan was not only an act of philanthropy, it was geopolitics rendered in dollars. Massive transfers of goods, credit, and investment underwritten by the United States rebuilt infrastructure, stabilized currencies, and anchored Western Europe inside an economic orbit that favored open markets and dollar liquidity. That reconstruction had a clear political payoff. It made Western economies less vulnerable to revolutionary appeals and more integrated into a
US-led commercial system. Money, in this case, created a geopolitical shield. History.state.gov. Those early moves set the stage for a second realization. If you control the currency and the channels through which credit flows, you control who can run deficits, who can import, and who can finance expansion. The Bretton Woods dollar became not just a medium of exchange, it became a geopolitical instrument. States and institutions that could access dollars could buy allies, arm proxies, and invest in strategic industries. Conversely, actors shut out of dollar markets would find their strategic options sharply constrained.
That asymmetry shaped diplomacy, intelligence operations, and economic policy across the Cold War. But the financial system did not neatly cleave according to ideological lines. Two phenomena cut across any notion of a straightforward East-West financial curtain. First, London's Eurodollar market emerged as an offshore center where US dollars were deposited and lent outside US jurisdiction. Eurodollars, not European currency, but dollars held offshore, enabled flexible credit flows, and London became an axis where money moved with a speed and opacity that traditional national systems could not match. The Eurodollar market allowed capital to flow around regulatory constraints, create new forms of liquidity, and, most importantly, provide channels through which unusual counterparties could transact.
In the shadows of regulation, dollars could follow opportunity, not ideology. Science Direct. Second, the Soviet Union, opposed rhetorically to Western capitalism, needed nonetheless the West's finance and technology. The Soviet leadership had been engaging with Western banks for decades, securing trade credits, loans, and investment deals. Much of the external trade of the USSR, from industrial equipment to raw materials, depended on credit arrangements running via Western financial centers. These flows were at times opaque and at times carefully managed through instruments such as oil-backed loans. In short, despite the grand ideological divide, the Soviets and the West shared aspects of the same monetary infrastructure.
The global banking system, with its private and offshore layers, provided both sides opportunities for leveraging credit in ways that contradicted their public rhetoric. CIA banks, for their part, were opportunists more than diplomats. Western banks, London firms, American banks with European branches, Swiss intermediaries, saw profits in financing trade with the Soviet bloc, especially when energy and commodities were at stake. Oil, coal, and grain facilitated the intersection of political adversaries. Exporters needed markets, importers needed sources, and banks could slice the risks into packages tailored for willing lenders.
Lending to the East was not mere charity, it was a business opportunity, and bankers found ways to design contracts that minimized political risk while maximizing fees and interest. That business dynamic knitted together economies that public rhetoric insisted were adversaries. The financial logic was understood by the CIA and other intelligence services and weaponized. Official channels carried overt aid, covert channels carried covert power. Intelligence agencies were routing funds to friendly parties through covert financial operations, financing paramilitary groups, supporting political parties, and creating influence networks across continents.
Such activities often depended on shell companies, falsified invoices, and bank accounts in jurisdictions where ownership could be hidden. Such methods moved money in ways formal oversight could not detect easily, and foreign policy aims could be pursued without the optics or constraints of public budgets. The shadow economy of intelligence financing became a core tool of Cold War strategy. CIA +1 energy transformed these dynamics. The petrostate era of the 1970s, a time when oil prices soared and petrostates amassed enormous dollar surpluses, altered the plumbing of global capital. Oil exporters were paid in dollars and ended up holding huge dollar balances. That pool of dollars had to find investments. Banks, bond markets, and U.S. treasuries absorbed much of this flow. The recycling of petrodollars back into Western financial markets strengthened the dollar's global role after the breakdown of Bretton Woods, providing the United States a new means of sustaining demand for its currency. The dollars earned from oil sales created a self-reinforcing circuit that funneled capital into distressed or strategic sectors, underwriting projects, debts, and geopolitical maneuvers across continents. Investopedia, this money circuit meant that the real front lines of the Cold War often lay in bank meetings and commodity deals rather than battlefields.
Lending could empower proxies. Credit lines could extend the life of regimes. Financing could make economies dependent and thus politically pliant. Arms manufacturers, construction firms, and state-backed banks all learned to follow the money. Proxy wars were not only fought with bullets and advisors, but also with letters of credit, export credits, and debt guarantees. Even the arms race, for all its theaters of missiles and bases, also underpinned financial flows that sustained industries and alliances. That interplay between military strategy and financial incentives turned the global economy into part of the battlefield. Consider the Afghan War, a conflict of guns and ideology, yes, but also one enabled through secret funding networks that routed money, arms, and logistics to insurgents via third parties, private contractors, and opaque financial arrangements. At the same time, of course, sanctions revealed how leaky the system could be. To the extent that enforcement was incomplete or middlemen would provide routes around, sanctioned actors could find avenues for circumvention. That produced a long-term game of cat and mouse between regulators and those who would retain economic access through treaty loopholes, third-country conduits, or cryptic financial structures. The diversity of institutions populating the shadow economy was remarkable. International financial institutions, export credit agencies, national development banks, private banking conglomerates, and a phalanx of front companies took part in shaping flows.
Private actors, traders, insurers, legal advisors helped anonymize and structure deals in ways that accommodated political risk. Lawyers wrote contracts that normalized complex repayment schemes. Insurers assumed politically risky bets for a fee. Correspondents in offshore centers executed cross-border transfers without the glare of domestic regulators. Every technical innovation in finance, letters of credit, syndicated loans, eurobonds, and later derivatives, offered new tools for geopolitical actors to deploy. Still, opacity rendered the system fragile too. When flows stopped, economies and regimes often suffered acute stress. Bank runs, credit squeezes, or sudden stops in capital flows could induce crises that had geopolitical consequences.
For instance, when commodity prices collapsed or when lenders abruptly revised their assessment of sovereign risk, debtor states were subjected to painful adjustments. Sometimes those economic shocks would translate into political instability, opening space for coups, revolutions, or realignment with alternative patrons. In that way, finance both built and broke states. The fall of the Berlin Wall and contracting empires did not end the money trail, it reshaped it. The relationships built in the shadows reconstituted themselves in new forms. Former intelligence channels were repurposed, commercial actors opened new markets in the post-Soviet space,
Oil wealth circulated through Western banks and reinvested in global assets.
The network that had once financed conflict and containment now mediated privatization, capital flight, and cross-border acquisitions. The same offshore havens and correspondent banking relationships that allowed secret flows now facilitated new flows of wealth, some legitimate, some illicit. Understanding this evolution compels us to realize that globalization is not the spontaneous product of markets alone, partly an unplanned consequence of Cold War finance. In an improbable alignment, bankers, intelligence services, and state export agencies, each pursuing their objectives, spun a web of liquidity that linked far-flung corners of the world with key financial centers.
That web made trade and investment possible on a scale unimaginable to previous generations, but it also left behind several legacy features: secrecy, concentration of financial power, and the political weaponization of money. Historians and financial investigators alike have traced links that interconnect intelligence budgets to private finance. Declassified papers have revealed operations in which covert funds have underpinned cultural diplomacy, vibrant media, and even political parties. Often, these covert investments were justified as some form of defense against ideological expansion, and their accounting deliberately obscured the sources and methods involved.
Covert credit lines and shell transactions did the job where open appropriations would have been politically odious. These documents also show how intelligence priorities sometimes emphasized financial engineering, creating plausible deniability, ensuring plausible repayment, and insulating friendly actors from direct exposure. Banks faced moral and legal dilemmas. Lending to authoritarian clients might bring in profits, but also reputational risk. Servicing opaque accounts to be lucrative while exposing institutions to future sanctions. Over time, scandals revealed how banks had facilitated illicit flows, laundering money for dictators, enabling sanctioned trade, or acting as conduits for stolen assets.
Regulatory responses grew: know your customer rules, anti-money laundering regimes, and tighter correspondent banking standards. But financial creativity often outran regulation. As new tools were invented, so were new methods to hide ownership and transactions. The role of petroleum deserves special emphasis because oil did not simply create riches, it redistributed financial power. As long as the oil exporting states were accumulating dollar surpluses, they faced the question of how to invest them safely. U.S. treasuries, Western banks, and offshore funds were obvious destinations. This recycling of petrodollars financed development projects, bank loans to emerging markets, and government bond purchases that kept U.S. financing cheap. The asymmetry was evident. The strategic significance of oil reinforced economic dependencies, and those dependencies became levers in a geopolitical game. The ability of nations controlling oil markets to reshape trade routes, monetary flows, and political alliances was possible. In this way, the oil-dollar relationship served as the cornerstone of the late Cold War financial architecture. Investopedia. Yet there were contradictions in the system. The U.S. wanted to maintain dollar dominance while running deficits. Petrodollars helped, but they also meant that U.S. policy needed to accommodate the interests of oil exporters.
Later decades would show how that dependence could be leveraged or be turned into weaknesses. When states like Iran or Iraq succumbed to conflict or confrontation with the West, attempts to isolate them economically met resistance from the very system that had been built to integrate global money. The very networks that allowed Washington the leverage over global markets could punish or coerce, but equally could be circumvented by resourceful actors. Another underlying factor in the secret web of money is the involvement of corporate extractors and contractors. Large Western corporations, oil majors, armaments manufacturers, engineering companies, were occasionally the financiers of financial diplomacy. They provided packages of technology, infrastructure, and credit that could attach recipient countries to long-term economic relationships. It was in those corporate state alliances that the distinction between private profit and public policy became unclear. Payments of contracts involved complex currency while being prefaced quite often by intergovernmental guarantees, export credits, or insurance. Those arrangements extended the influence of Western capital, but also made host states dependent on revenues and expertise concentrated outside their borders.
The aftereffects are still with us. Offshore finance, complex corporate ownership structures, and the global reach of a handful of financial centers are in part the legacy of Cold War arrangements. As the ideological competition subsided, the structures of secrecy and concentration survived, and in many respects intensified. New tools, electronic transfers, sophisticated derivatives, multinational corporate law sped up the size and velocity of flows. Yet the fundamental mechanics resonate with what emerged during the Cold War: the centrality of the reserve currency, the offshore liquidity pools, the intelligence finance nexus, and the strategic use of credit. There are lessons here for policymakers and citizens alike. First, power in the modern world is as much financial as it is military. A state controlling access to liquidity and credit markets possesses tools to reward friends and punish adversaries.
Second, secrecy in finance is a double-edged sword, on the one hand enabling covert action and the evasion of sanctions, on the other breeding corruption, instability, and moral hazards. Third, economic integration can breed resilience by diversifying trade, but also engenders dependencies with political costs. Only considerate regulation, transparency, and international cooperation will reduce harm while preserving most global markets' benefits. Finally, the secret money trail is a story of unintended consequences. Financial instruments devised to solve one problem, marshal reconstruction funds, stabilize currencies, facilitate trade, became repurposed for geopolitical goals.
Offshore markets that serviced legitimate trade camouflaged covert operations. Petrodollar recycling that stabilized markets also strengthened the dollar's geopolitical role. The Cold War's financial legacies remain with us, not because of deliberate design, but because of the path-dependent manner in which institutions, markets, and political imperatives hitched together. When we consider that era in retrospect, it is easy to pay attention to generals and ideologues, but the true architecture of power was more often drawn by bankers and bureaucrats who could write contracts, draw up credit lines, and create shell entities. The invisible channels they engineered became the real mold into which the outcomes of revolutions, the life and death of regimes, and markets rising or falling were cast.
The Cold War came to vindicate a stark truth about world politics. He who controls the money controls much of what power can do. The modern era brings with it new questions. How do we curb illicit finance without strangling legitimate commerce? How do we keep intelligence channels accountable without damaging legitimate national security tools? How do we build a monetary system that is both resilient and just? These are not abstract questions. They touch on migration, development, inequality, and the very capacity of states to act in the public interest. The secret money trail reminds us that geopolitics is not only fought in the open, it's fought in the vaults, on the books, and across correspondent lines that crisscross the globe.
Documenting those flows, holding institutions accountable, and understanding how money shapes power are the ways one crafts a more just and stable world. The Cold War taught us that the real weapons of influence can be quiet and technical, and that their effects can outlast the regimes and ideologies that first forged them. The missiles may be gone, but the financial system they helped create still runs the world. The profits and losses were recorded not only in military after-action reports, but in bank ledgers that document who paid whom, where weapons were procured, and how funds moved across borders. Likewise, in both Latin America and Africa, the economic levers of loans, subsidies, and investment choices were part of each bloc's geopolitical toolkit for lining up allies and undermining rivals. Sanctions represented the flip side of these approaches. As states determined that it was advantageous to apply pressure to adversaries without military engagement, they learned to weaponize finance, block access to dollar markets, freeze assets, and make global banking contingent on political compliance.